you think you're right about a stock, but nobody else thinks you're right, you don't get paid. So some people want to find something called a catalyst, but I think catalyst is basically a fake concept. Markets realize things over time. Sometimes markets realize things faster with certain kinds of news or like patterns of news. I think like sometimes there is a hardcore catalyst, but it's often kind of not really true, in my opinion. If people know about a catalyst, then everyone knows about it, and it's not really, it ceases to be a catalyst. Take losses, I think, is like the best thing you can do in trading. Just start to trick yourself into loving taking losses. Oh, that's great. I'm so happy I took this small loss. The human mind is not conditioned to think that way. That's why trading is hard. I think time is in the catalysts, but markets are tools that get more accurate with time. The market at a nanosecond is not very accurate, but the market at 5 years is very accurate. It's very seldom that a stock will stay irrational for 5 years. It does happen. It has happened over 5, 10, 20 years, you know. A lot of people don't understand this, which is really interesting. When you're trading, one of the main goals is to actually maximize the amount of trades you make, which sounds kind of crazy, but you try to maximize the amount of trades you can make while you're maximizing a few other things. You're trying to maximize, you know, your turnover or the amount of trades you're making, but of course you're also trying to maximize the number of times you're right, and then you're trying to maximize kind of your profit when you do win and your losses when you do lose. You're trying to minimize the losses and maximize the profit. So you're kind of what your slugging ratio is, if you will. You know, when you do get the hit, do you get a big hit, or are you just taking a small, quick profit? And when you do get a loss, are you getting smoked, or are you taking a small stop loss? You know, because you could have a 90% win rate, but if this is like, I make 1K when I win and I lose 100K when I lose, that 90% win rate doesn't help you very much. And then here, as long as all else being equal, you want your turnover to be as fast as possible. And you want to make 10 trades a day, or do you want to make 1,000 trades a day? Well, if the other two parts of the triangle are in good shape, you kind of want to make 1,000 trades a day. If you can not hurt this, right? Nobody has a 90% win ratio other than maybe Buffett, because he makes 10 trades a year, if that. Let's say you have a 60% win rate. You know, maybe from going 10 to 1,000 trades a day, you might lower your win rate to 51%. And you just have to think about, well, does that help me or hurt me? You know, at 60% win rate, maybe P&L looks like this. Maybe you make $5,000 on trades you win at, and you lose $6,000 on trades you lose at. So if you're making 10 trades a day, that means you're making $50,000 on your longs. Well, you're actually making $60,000 on your longs. You make 6 winning trades and 4 losing trades, right? 6 times 5K is actually 30,000. And this is on average. And then, you know, your 4 trades you lost money on, you're losing 24K. So your net profit 6K every day. That's a pretty good trader. You know, 6,000 a day is around 1.2 million a year of P&L. This is great. So the question is, how does this trader make more money? Well, he can either up his win ratio. He can try to lose less money when he does lose, or make more money when he does win. Or he can trade more. So if he could add a 0 to all of this, he would actually go up to 300K, 240K. The problem with adding a 0 is the trade quality will probably suffer. And this is a lot more interesting, right? This is a $6 million P&L a year. Actually more, it's like 12 million. This is almost a professional level P&L. So, but the problem is, if you say you need to do 10 times more trades than you're doing before, you're going to say, well, I could do that, but it's going to look a lot more random. And we could do that math. So let's say, you know, at 51%, it's, I don't know, 5K versus 5,500 in losses. And now again, we have 1,000 trades a day. So 510 are winners, 490 are losers. I'm making 5K for these. I'm losing 5,500 for these. What's my P&L? This may be negative, right? This is 2.55 million a day in profits. This is like a quant bot. And this is 2695. You'd be out of business very quickly. So you say, I know my trade quality would drop so much that I don't want to do this. I would lose 100 grand a day. huge losses, catastrophic losses. So maybe it would be 53%. I don't know. You can set the break evens for what you could profit on, but you can think about doing this math for yourself. But you want to maximize turnover, you want to maximize win rate, and you want to maximize slug rate ratio, all else being equal. They all impinge on each other, obviously. I'm getting close to betting my gender, yeah. If you want big returns, you got to be willing to take big losses sometimes. You want moderate gains, you need to take moderate risk. You want baby gains, you take baby risk. You can take insane risk, but the problem with insane risk is, even if you're right, you might not live to see it. Yeah, you want the right amount of risk that lets you stay in the game, but also, it has to punish you if you're wrong or early or whatever. But you don't want it to punish you so bad that it's over. And typically insane risks do not give you insane returns. They just give you insane risk, and it's because then you need to time it exactly right and things like that. I don't think you need to survive a 10x because 10x's just don't happen that often, but maybe a 3x. Certainly a 30% move should not put you out of business in one stock, but 100% move can 150% move, something like that. And you could, if you're worried about your existential risk, usually you can buy really out of the money calls to hedge you a little bit. You can hedge any which way. Doesn't matter. Yeah, D-Wave is Sava level conviction. Not every stock, I think this is one of the biggest things that beginners don't necessarily understand. There's not necessarily explanations for why stocks are up or down. The way computers do it, or the way a lot of people think about it, is as linear combinations of factors. So you have some coefficient, I guess we can do big letter A, and then you have some factor, we'll do alpha, and then the return can basically be explained by this linear combination, big letter B and beta. I'm mixing capitals and lower cases here for clarity. Big letter C and gamma. And so each of these are, the coefficient and the factor. The factor can be something like value, momentum, country, industry. There's hundreds of factors. And you do a linear combination of them, and the best fit of this linear combination will explain the change. News, of course, will do that too. Beta is a pretty big one. Let's use beta for beta. Yes, good idea. And what's left is called alpha, right? So you can't really explain everything, nor should you seek explanations all the time, right? You should have the conviction that your pick is a good pick, and that's it. Why is the stock up or down? If you want to really chase these things down, you can figure out that, this guy is selling the stock at this fund and he's moving the stock down. And then you go ask the guy and he just shrugs his shoulders and say, I just decided to get out. He's no smarter than you or me. Well, you would know you're wrong when the company actually starts making money or something like that. The share price is not. The share price, Buffett, a good example is Buffett said, well, the share price is like your crazy neighbor. And every morning as you leave your house to get your car to go to work, your crazy neighbor just starts yelling prices at you. I'll buy your house for $100,000, or I'll sell you my house for $10 million. And you're like, all right, John, no thank you, but I appreciate it. But one day your crazy neighbor is going to say, I'll buy your house for $10 million. And you say, whoa, wait a second, what? Sold to you, buddy. Or I'll sell you my house for $5. And you say, okay, I'll buy it. And, looking at the prices are just for you opportunities to make choices. Of course, there are people who believe that they can learn something from the prices themselves. I think that overwhelmingly the actual businesses are what matters. Buffett became the most successful investor of all time by studying businesses, not by looking at stock charts or price action or anything like that. I don't think Buffett cares about rallies, right? He's not a trader. He's like a private equity style investor. Whether Buffett cares anymore or not, I think it's indisputably he's the greatest investor of all time. IVVD is one of these stocks where it shoots up, it feels like it's going to go up forever, then it just drops and goes back down. I think you have to don't be a pig and just sell it when it goes up like this, and always keep a little bit. But I think a lot of people like trading HIMs and some other things. When I trade, what's most effective for me is trying to capture most of the move. I think you can't blame yourself if, let's say, you buy stock, let's see, something like this happens, and you identify this kind of buying spot. I don't know, let's say you buy stock here, okay, because you think you're going to have a rally, and it kind of drops a bunch, and it goes up here. Well, again, nobody can time the market perfectly. So the error bounds around the times when you feel like you're wrong. So here's the purchase price. There's some error bound where you say, I'm wrong. And there's some error bound where you're willing to say, I'm right. I'm still right. I'm wrong right now, but I'm going to be right. And, because if you make your error bound so small, you're going to stop yourself out every second. And nobody's that right. But if you make your error bound too big, you basically say, I don't care if this stock goes to $1, I'm still willing to buy it. And I'm still willing to call myself right. So over here, you start to think, okay, maybe am I wrong? Is it over? And then over here, you're breaking even and you say, I don't know, should I get out? I got my money back. But let's say you sell, let's say over here. This is a good trade, right? You bought here and kind of sold here. That's a trade. It's great. You like that. But then when it's up here, you start to ask yourself, why didn't I hold on to it? Well, that wasn't your goal. Your goal was to buy the stock and sell it for a higher price, and you did that. If your goal was to buy the stock and hold it for 10 years, then you didn't do that, and you probably did do something wrong. But if you had a successful trade, especially if the IRR is good, if this time period was a short time period, you should be thrilled. What you want to avoid is losses, but not making enough gains is not a big deal. You might regret it a little bit, but it's not that big of a deal. So anyway, let's say, you shorted a stock, you shorted down here, and, you just feel like this is your error bound. And after enough errors, let's say you stack these up. Oops. A little, I don't know, about after 2 or 3 of these, you could probably start feeling like, all right, I can clearly mess this trade up. And I don't think you have to wait. I think you can just get out because you're going to have lots of these, right? And so you book this as a positive. So wins, losses. Okay, I got 1 win from this guy. Then you get out of this and you say, I have 1 loss. All right. And just keep doing this over the course of a year. You might have, at the end of the year, 91 wins and 81 losses. This is a really profitable trader. I think what you don't want to do is say, I need my wins column to be all wins. That's just not going to work. So I'm going to avoid taking the loss. I got 1 win here, but I still have this loss just waiting to be taken. And I had another win, maybe I had another loss, but I'm really refusing to capture my losses. So I keep adding them, maybe occasionally take a loss, but I've got like 5 or 6 losses down here that are still germinating, but I haven't taken them yet. So I want to keep waiting them out. But the problem is these are probably your worst trades because clearly you got something wrong, but you're going to let it stay in your portfolio and let it corrupt. And when clearly you got something wrong, you don't understand the fundamentals as well as you thought you did, or something like that. It's okay to have a few of these, but you also don't want this to be disproportionate. So if you have no winners you're waiting on and only losers you're waiting on, and then you only have winners you've booked and you don't have many losers you've booked, you probably want these to be symmetrical. So if you just are willing to book winners early and then not willing to book losers until they become winners, that's generally a really good recipe for losses. And in fact, you want to do the opposite. You kind of want to let your winners run and kill off your losers more often. But it's hard to do mentally, especially for very intelligent people. They tend to want to be proven right. It's hard to admit you're wrong sometimes. And admitting you're wrong is the most important thing there is in trading. Some people go even more extreme. And there's some people in this chat that like to mention this. There's some people that say that, look, the point of the trade is to make money. The second you're losing in the trade, you're wrong. I don't think that's right. I think that's too extreme of a viewpoint. But the point is still taken, which is, you're not trading for fun. You're not trading for intellectual stimulation. You're trading to make a profit. So you don't want the stock to go in the wrong direction, especially if you don't have super conviction. But even if you have super conviction, you certainly don't want the stock to get too far away from you. And that's just kind of the nature of trading. But stopping losses from growing is definitely just as important as keeping your winnings growing or finding winners. So the biggest mistake people make is their position sizes are too high, and that's something that's it's hard to reconcile sometimes, because you know the Kelly criterion is a good example. You know, do we undervalue or overvalue Kelly? You know, Kelly is the theoretical, best way to allocate capital. It's in fact not theoretical. It's literally proven. But there are problems with Kelly. Anybody know some of the problems with Kelly? Well, we tend to be overconfident in how right we are. We tend to be very overconfident in how right we are. If anybody doesn't know what I'm talking about, look up the Kelly criterion. Sarepta is my biggest long, but maybe you made it much bigger long for you, but that's your problem. I'm almost break even on my Sarepta short long. Yeah, exactly, Brian. It's just gut vibes. So a lot of people do half Kelly or quarter Kelly, but yeah, you don't have probabilities. You have real probabilities. Yeah, the GameStop thing was crazy. I was trying to short it from prison. I didn't get a chance. I like that bio thriller. That'd be fun. Kelly's great. It's just very hard to use practically. This is the guy you should be following. Not Burry, not Pelosi. This is the guy. This is why you watch Shkreli.
They think it's about growth often, okay, or something new. Neither of those things in themselves are, to us matter. Let's say the types of investing that we do is high barriers to entry, the moats that Warren Buffett has talked about. Now, before we dig into that, can a distressed asset of a piece of real estate that's selling at half price because of a liquidation also be a good investment? Yes.
So you can have a zero discount rate, but the key is all cash flow streams eventually go to zero, right? So for example, in pharma, the cash flow stream of a drug is virtually guaranteed. People are going to stop taking the drug. Once you're on a drug, you're on it, especially if it's chronic illness, right? But the patent expires, so your cash flow goes to zero. So what businesses have a moat? What businesses are going to stay around for 100 years? It's pretty hard to determine. If you look at the Dow Jones from 100 years ago, these are very weird companies that you may not have heard of. Dow Jones constituents 100 years ago. There are 12 original companies in the Dow Jones, okay? How many of you think of that? How many do you think still exist? American Cotton Oil, American Sugar, American Tobacco, Chicago Gas, Distilling and Cattle Feeding, GE, Laclade Gas, National Lead, North American, Tennessee Coal and Iron, U.S. Leather, and U.S. Rubber. GE is the only one. Just keep in mind that, some of them exist through M&A, no doubt. Businesses just don't disappear, but a lot of them are smaller. So keep that in mind. Copper mining, smelting and refining. You can combine all the mining companies, they still wouldn't be worth putting in a Dow. International Paper is kind of like a mid-cap now. So they're still around, they're just not valuable. So what moats, what cash flow will endure is the question, because when you have confidence, your discount rate drops. Banks could be good, but banks depend on management. You make bad loans, that's the end of the bank. So that's not really a moat. Steel, well, technology changed steel. Steel become a little less important. Nothing stays forever. B.F. Goodrich, Western Union. Western Union was one of the biggest companies in the world. Westinghouse, sugar refining. Sugar refining? The American Sugar Refining Company. What? The American Can Company. The American Beet Sugar Company. These were your leaders? Studebaker Corporation, of course. There's Studebaker. I'm old enough. I remember Studebaker. I read the 10K. The guy on this paper, you couldn't even turn the page. It was such brittle paper. For the 10K at the annual meeting, I used to go to the meeting in a horse carriage. They send me the next 10K. It will come in 3 weeks after the results. Sears Roebuck, Anaconda Copper Mining, Baldwin Locomotive. There's DuPont. That was a real one. You're real for that one. American Tobacco Company, I think, became Philip Morris. There's AT&T. AT&T was kind of a forever company, kind of like what Chris Hone is saying. I mean, what's the discount rate, right? And if you're trying to give these shares to your kids or something like that, then you kind of don't have a discount rate, right? As long as the cash flow is there, you're not really discounting it because, you know, the biggest risk, there's kind of like two, you know, what you learn, the first formula you learn in Braley-Myers is this dividends divided by what? Risk. And you can do dividends divided by risk minus growth. And this is it. This is how you price an annuity, basically, right? This is like the fundamental. We don't sell at API yet, but we will at some point. This is the fundamental. You know, every field has a fundamental kind of formula. This is the fundamental formula of finance. With this is kind of the key thing. So growth is something that's really important. All three of these things are important. So this is the cash flow. This is the growth of those cash flows. And this is the risk to those cash flows, including time value of money risk and things like that. So if D goes down, you know, you have a problem because nothing else matters, right? The rest of the formula is irrelevant. If there's so if D is pre-planned to go down, like pharma, we know the drug's going generic. That's part of the game, right? But Coca-Cola, I was going to say KO. Coca-Cola, there's no plan, at least, for revenue to go down. So this dividend should be good, right? There's no game plan to that's not part of the business model. It's their plan is to grow. Now, can they grow is another question. The game plan is to grow, but what's the risk? What's the risk that in 50 years they have no cash flow? And how much do I discount it by? If I discount it by 2%, that's my risk-free rate, or that's my inflation rate, then my even 2050 cash flows matter, even 2070 cash flow matters. Risk is kind of subjective, and it becomes objective after you receive the cash flow. Growth really doesn't matter that much if you can secure the bag and that you can believe that this dividend stream, this income stream is for sure, this discount rate drops like a rock. There's only so many companies that have that. That's why people focus on moats so much and play around with the numbers, you know, open an Excel. So let's say a company is going to grow at 1% a year, but here's 150 years, 160 years of growth. And then I got a company that's going to grow 10% a year. No joke, 10% a year for 10 years. What's the more valuable cash flow stream? I know all of you people, okay? Yeah, you watching right now. You would say, why would I buy this company? That's crazy. I'd much rather buy this company. It's going to grow. Let's do the math. Yeah, you people. It's a lot of value there. Let's say $1 billion or $1,000, depending on how many zeros you want to put in front of it. It's 10 times earnings too. Not bad. This no growth company is worth 8 times more, simply because you can see that it's going to be around, and other investors will pay that premium. You don't have to live that long. What happens if the fast growth company just has a decay in cash flows? Doesn't go to zero, but it just decays. Doesn't change much. Doesn't change much. Added 30-40% to the matter. Or if it starts declining really slowly, it's still going to decline to zero. That's the problem. Cash flow is a long time away from now. You don't know what Microsoft's going to be doing in 2030 or 40 or 50, do you? Or Apple. You're just trusting the guys that are running it are going to be good guys, but it could be anything. Berkshire's assets have a moat. Berkshire itself doesn't have a moat. It's the risk. It's the risk to the cash flows that matter. And that is embodied in the discount rate. If you discount the cash flows at 7%, you're saying that there's a good chance these cash flows won't show up. So you got to find the company that has the strongest. This is what this guy's been talking about. I don't know if you've been listening. Some of you haven't been listening. The strongest moats to cash flow.
Our companies have recurring and predictable revenue streams of essential products, right? Yeah, and so
do they have to grow?
Depending on valuation, not necessarily.
Amazing. See what he just said? Kind of took the words out of her mouth. Do they have to be growth companies? He said, not necessarily. Interesting, right? So is Facebook and Instagram still going to be here in 10 or 20 years? I don't know about that. Network effects can sometimes be a little overvalued, in my opinion.